In Chapter 26, we start talking about planning for capital investments. Capital investments are long-term assets that we are planning to use over a long period of time. Now, this is the capital budgeting section, and it's different than the operating budgeting section that we did back in Chapter 23. That's where we plan for the year coming up, the revenues and the expenses we need to spend in our operations. So if you remember that whole master budget, we went through that whole process to come down to the net income, and then that net income fed into the cash budget at the bottom of our master budget, into the financial budgets. Well, over to the left, I think, on that diagram, there was a section called the capital expenditures budget. That's what we're talking about here. This is where we plan for the number of items that we're going to spend money on that's going to take more than a year to pay off or to use up. And so doing the capital expenditures budget is important because it helps feed into our cash budget. And they talk a little bit about, over on page 1206, the steps that companies go through. First, they go through and they ask for the proposals for the different projects or pieces of equipment or items that people in the business want. Second, they go through and they review those projects and review them. And then three, they evaluate them using techniques, financial techniques. That's what we're going to talk about primarily in this chapter, those financial techniques. And then finally, the fourth step is that the Board of Directors approves a capital budget, usually based upon some sort of a ranking. Now, different companies have different ways of budgeting, capital budgeting. Smaller companies, it may just be informal. The owner might say, I can afford $100,000 next year. These are the items I want to buy. But a big company that has many operations has a lot of needs. And like most of us, companies don't have unlimited amounts of money to spend. So they have to go through and prioritize all of these capital budget requests that come in to determine which ones give the best return to the company. And that's what we're going to be talking about. That's step 3, where we evaluate the projects. And there's a lot of different techniques you can use to do that, but the goal is the same, to pick those projects that are going to provide a positive return to the company and then prioritize based upon the ones that are going to give the highest positive return. So with that in mind, we're going to start with talking about something called cash payback. Now, most of the items we're going to talk about today are going to be looking at the cash flows of potential capital projects or acquisitions of equipment. And when we say cash flows, we're going to look for cash that's going to come in as a result of investing in this project. That cash might be additional revenues because we're going to generate more revenues with this project approved. It might be savings and expenses. If you get a piece of equipment that's new, that uses less electricity, and it saves you $20,000 a year in your electric bill over the old equipment, that $20,000 savings is a cash inflow because it's saving you money. We're also going to look at cash outflows. And cash outflows are where you spend money. So if you buy a piece of equipment, you have to spend money on it. If you have to maintain it in the future, you spend money on it, that's a cash outflow. If you have to pay to operate it every year, that's a cash outflow. So when we're looking at all of these different types of tools, we're typically looking at the cash outflows and the cash inflows that each of the projects are going to be generating. And they talk about that on page 1207 and give you a summary. So with that in mind, let's talk about the first one, probably the simplest one, on the bottom of page 1207 and up at the top of 1208. It's called the cash payback or cash payback technique. Now, the nice thing about this is it looks at how long it's going to take us after we make an investment to get our money back. And the idea is you want to get your money back sooner. That makes it a more attractive investment than another project or a piece of equipment that takes you longer to get your money back. So they give us some examples here, and they go through and they say, okay, we have a piece of equipment that we're looking at possibly buying. We're trying to decide if we want to do it or not. Okay, and so the cost of this equipment, and this is on page 1207, would be $130,000. So that's how much we'd have to pay up front. That would be the cash outflow today. We think it's going to last, estimated life, useful life, for 10 years. And there's a salvage value of 0. So at the end of 10 years, it's not going to be worth anything. Now, while we're operating this piece of equipment, we estimate that we're going to have some money coming in, some cash coming in, and cash coming out. So estimated annual, this is important, cash flows, this is each year. We're going to have cash inflows from customers. We're going to get money from our customers. This project's going to allow us to get more revenue, so we're going to get $200,000 a year. But it's also, we're going to have to spend money. We're going to have to pay money out to operate this piece of equipment. So that's going to be a cash outflow. and that's going to be at $176,000. Now, these are obviously all estimates. This hasn't happened yet. So a big part of doing a good capital budget is to make sure that you've got good assumptions. And companies who do formal capital budgeting spend a long time going through and making sure that these projections are accurate. Here you're just given the numbers so we can do the calculations. But keep in mind, coming up with these numbers on a project that's going to last 10 years can be quite a bit of work, and there can be a very detailed cash budget just by itself. But with that said, the cash coming in, $200,000, the cash going out, $176,000, gives us a net annual cash flow of $24,000. So we expect for the next 10 years, we're going to be getting $24,000 a year as our estimate. Now you go, okay, well that's nice. Well, what do we do with that? Well, we're going to use something called the cash payback, okay? We're going to use that to go through and calculate. And our cash payback calculation is this. The cash payback period is going to be calculated as the cost of the capital investment, in other words, what you spent for it, divided by the net annual cash flow. How much money we're going to get each year. So in this particular case, we're planning on spending $130,000, so that's our cost of our capital investment, and we think we're going to get every year an even $24,000. That's our best guess. So we divide that by the $24,000, and that works out to be, if we get $24,000 a year in 5.42 years, we'll get all of our money back. So that's the payback period. That's how long it's going to take us to get our money back. Now the idea is that the shorter this time period is, the more attractive the project is, because we're going to get our money back sooner. So we look at these projects and we want the ones that give us the shortest time period. That's more favorable. So the advantage of this is it's real easy. It's easy to understand, it's easy to calculate. The disadvantage are two things. One, it doesn't take into account time value of money, and we're going to talk about a method to use for that later on. But the other method that's a problem, or another reason it's a problem with this, is that it doesn't tell us if this project's going to be profitable or not. It just tells us how long it takes us to get our money back. It doesn't tell us whether the money we're going to get back is more than what we're going to spend. So there's some other methods we're going to use, but this one gets used a lot because it's very easy. Now the nice thing about this one is, that easy formula works really, really well if you only have even cash flows. In other words, every year you get the same amount. But what happens if you get uneven cash flows? Sometimes the cash comes in at different patterns. So you might get more cash at the beginning and then it falls off over time, or maybe you get less cash up front and more cash later on. Well, if that's the case, we can't use this formula as is, because that gives us, it has an even number. So we have to go through and we have to look at what happens when you have cash payback with uneven cash flows. Okay? So this was with the even cash flows. This example was pretty easy. Let's look at an example on page 1208 where we have uneven cash flows. So in this particular case they give us, the company is looking at purchasing a piece of equipment for $300,000. All right. So we have 5 years. So let's just put the years up here. We have year 1, 2, zero, because that's the year that we're going to start. And then 1 at the end of year 1, end of year 2, end of year 3, end of year 4, and end of year 5. So our initial investment we're going to make, the investment, is going to be $300,000. And then the cash that's coming back each year, our net annual, I guess I use that word, cash flow, is not even. In year 1 we're going to get $60,000 back. In year 2 we're going to get $90,000, so you can see it bounces up quite high. And then year 3 we're going to get the same $90,000, so we're getting more money. In year 4, it goes up even higher. And then finally, in year 5, it goes down a little bit. So this is how much money we're going to get. Now the question is, how long will it take us to get all of our $300,000 back? Okay? Well, it's kind of hard to see that, so what we need to do is create something called the cumulative number. Okay? The cumulative cash flow is just that. We go through and we add the cash flows up to see where we reach the point where we've got $300,000. Cumulative cash flows. So 60,000, end of year 1, we've got $60,000. That makes sense. End of year 2, we've got 60 plus the 90, so we've got 150. Next year we get another 90, so that gives us 240. The next year we get 120, so we're up to 360. And then finally in the year 5 we get 100,000, that takes us up to 460,000. So this is just accumulated these numbers. These are each individual number for each year. This is adding those up each year as we go forward. So using that we can say, oh well, when do we get our $300,000 back? Well, we get our $300,000 back somewhere between here and here, between year 3 and between year 4. So we know our payback period is somewhere between 3 and 4. Problem is we don't know where it's at in there. So what we have to do is we have to kind of do a little bit of what we'd call an interpolation. Okay? So let's go through and let's say at the end of year 3, so this is year 3, okay, 3 years, we have 240,000 we've got. That's how much we've received through here. We need 300. So we need to get another $60,000 sometime in between year 3 and 4. So how long into year 3 is it going to take us to get our $60,000 we need to get to 300? Well, if we look at the difference between these two numbers here, we can see beginning of year, or end of year 3 we get 240, end of year 4 we get 360. That's $120,000 change for the whole year. We need $60,000 because we want to get right in here where we have $300,000, right? Somewhere in here is where our 300,000 is at. That's 60,000 after the end of year 3. So we take the 60,000, we divide it by the difference between the 2 full years, so we're 120,000 in total. If we need to go 60,000 into that year, and there's 120,000 total between those years, that works out to be 0.5 a year, or a half year. So now what we would say is our payback period is going to be the 3 full years to get to the 240, plus another half year to get to the 300. So our payback period would be 3.5 years. So anytime you have uneven cash flows, you have to kind of go through and do this little cumulative number and then do an interpolation, if you will, in between the two numbers to see how far into that partial year you had to go. Okay? So that's not quite as easy as just doing it with the even annual amounts, but you can still go through and do it, and it's pretty straightforward. So that's a cash payback. So that's the easiest method to go through and use. But like I said, it doesn't look at profitability, but more importantly, it doesn't look at time value of money. And the reason that's important is because some of these projects, when you're doing capital budgeting, aren't for 3 or 4 or 5 years. They're for 10 years or 20 years or 30 years. If you're a manufacturing company, you might be putting in a product line or a new factory that might be used for the next 20, 25 years. And so over time, money has a value. Maybe you remember back in 201, in the chapter on bonds, you talked about something called time value of money. Well, that's a very important concept in the budgeting world for capital budgeting. Because the idea is that money has different values depending upon what time period we're looking at. So just to give you an example, let's say it's today. Okay, so today, and then we have a year from now, so we have year 1, year 2, year 3, year 4, and year 5. And so I were to say to you, hey, which would you rather have? Would you rather have $1,000 today, somebody give it to you, or would you rather have $1,000 at the end of 5 years? And you'll probably say, well, I'd rather have the money today. Because intuitively you know that you'd rather have it. And there's some real reasons why you could have that. It'd be better. Obviously, if I had the money today, I could spend it. But let's assume I'm looking at it from an investment standpoint. If I had the money today, I could go out and I could reinvest it. And I could earn interest or put it into something that's going to make me money for the next 5 years. If I get it today, then I don't have to worry about something happening so I don't get it in the future. In the future, something might occur. The person might decide not to pay me, so I might not get that. There's a risk I might not get that money in 5 years. There's inflation or purchasing power risk. You know that something that costs $1,000 in 5 years is probably going to cost more than $1,000. So you'd have to have more money. So the idea is that the further out we go, the money isn't worth as much to us. Even though if I paid you $1,000 today and $1,000 in 5 years, I'd still give you 10 $100 bills. That's what we call in econ the nominal value is 1,000. We know that that money is worth less in the future, that the money is worth more today. And so the idea of that is, well, how much would it be worth? Not to get it in that period of time, but what would it take for me to decide to get the money today instead of waiting? And so what we do is we look at something called present value. Present value says money in the future we're going to get doesn't have as much value to us. It's worth something less in today's dollars because it's going to lose value over time. So let's take that money and let's what we call discount it back to what it would be worth today. And so maybe that $1,000 would really only be worth $950 today, depending upon what discount rate I used. And another way of looking at it, if I put $950 in the bank at a certain rate and let it grow for 5 years, it would get to $1,000. That's called future value. Putting money in today and watching what it grows to in the future. We're doing the opposite, just the flip side of that. We're looking at money in the future and seeing what it's worth today. Present value today. Present value is going to be worth less than the nominal value in the future. Now that's an important concept because the further out you go, the less the money's worth, because of course inflation and other things make it go down in value. It doesn't have as much purchasing value. Also, the higher the interest rate, the discount rate we use to do this calculation also generates smaller numbers. And so when we start looking at projects that are going at 10, 15, 20 years, the present value today is a lot less than what the nominal value looks like out there 20, 30 years from now. So if you can't compare a project that's going to give you $5 million in 20 years with a project that's going to give you $5 million in 5 years, because you don't really know what those values are. So what we do is we take all the money in the future, we look at the cash flows for each of those years in the future, and then we discount them and bring them back to put them into today's dollars so we have everything comparable. Sounds like fun. Now the way we do that is we use something called time value or present value. And that's a mathematical calculation. And there's formulas and all kinds of fun stuff, but we're not going to do that. Instead, we're going to use the formulas are built into some tables. Before we do that, we need to look at, there's two different types of cash amounts in the future, okay? If you have an amount where you're going to get, let's go back to our $1,000. Okay? We're only going to get one payment of $1,000 out there, all right? That's what I would call a lump sum. We're only going to get one payment. Okay? On the other hand, if we're going to get a payment of $1,000 for each of the next year, 5 years, and that amount is equal, that's called an annuity. Annuities have more than one payment. But it's important, they have to be equal. Okay? So this would be an annuity of $1,000 for 5 years. $1,000 received each year. This would be a lump sum of $1,000 received at the end of 5 years. The reason that's important is because the mathematical formulas that you use to find present value have two different calculations. One for annuities and one for lump sums. And so you're going to be using your tables in Appendix G, and you're going to need to know which table to use. So that's why I want you to know when you can recognize an annuity versus a lump sum. Now, what happens if you have something like this, where you have payments for 5 years, but this payment is $700, this payment's $1,200, this payment's $800, and this payment is, $600. You have a payment every year, you have more than one payment, but the key is they're not equal. And since they're not equal, they're not an annuity. What you have there are 5 single lump sum payments. And if you're finding the present value of those, you have to find the present value of each one of those separately and then add them together to see what your total present value was. Okay, so you have to calculate the present value of this, 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 and then you add them all together to give you what your present value was for your lump sums. Okay? This is kind of handy because since it's an annuity, we can use a table and it's going to let us do one calculation to put all these in because they're all linked together. And so we'd only have to do one calculation instead of 5. So you just need to be aware of how you go through and calculate that. Now, given that, where are these tables you're talking about? Well, they have one of them what are called present value factors. And these factors are used to go through and to convert our nominal dollars to the present value dollars. In the back of your book, you have Appendix G. It's called the time value of money. And you have two tables. We're dealing with the present value. There's Table 3 on page G-8, and there's Table 4 on page G-10. And so I'm going to put these up. Hopefully this will work on the projector real quick and show you how to use these. But it's going to be very important. Students get it confused all the time between which one of these they want to use. Okay? So Table 3 is the lump sum. You only have one payment. Table 4 is the annuity, where you have more than one payment with the same amount. So let me go up and put these on the overhead, and hopefully we can see how they work. All right, I hope these are visible. I know they're a little hard to see, but again, we're over in the Appendix G, and we're looking at Table 3. So this is Table 3. It's the present value of $1. This is the lump sum, okay? This is where you only have one payment. And there's rows and columns. So the columns across the top, these are interest rates. These are what we call our discount rate. And this will be given to you because you need to know what the company is using for a discount rate. So that'll be given to you. Down the side, you have...
Mom?
Fine, I'm doing a video. You want to come be in the video? Are you guys need anything else in here?
I was cleaning up.
Oh,
So
that's
sorry.
fine, no
Tell me
problem.
everything.
Sure. Party crasher. Down the side, we have the periods of the time period we're looking at. So think of this as years. This is how many years you're going to be operating, right? And so what happens is, let's suppose in the example we had, I think we had the, let's look over on page 1210, all right? We had the company who was looking at purchasing the asset, and it was going to be, oh, that was an annuity, okay. Got to get my notes right here. Well, let's just go through and I'll show you how this works, okay? So what happens is, when we know what our discount is, we go to our discount rate we're using, and then we go to the year. So if it's the 5th year and it's 10%, we're going to go 5 years over to 10%. And then we're going to have this factor. In this case, it's 0.62092, if you can read that. That's the factor we're going to multiply by that payment that's made in the 5th year. If we have a payment in the 4th year of $800, we're going to go 4th year, 10%, because that's our rate. And we're going to use this factor, 0.68301, and multiply that by the amount of the cash that we receive in the 4th year. And then we'll add all those up at the end. So the reason we use this is because it basically eliminates us having to do all the math, and we just have to go through and do the calculations. So you're going to want to go back to your book. I think this was on G10 and G8 were the two tables. And Table 3 is the one you're going to use anytime you have a lump sum where you only have one payment that you're going to worry about. Okay? So that's Table 3. This is Table 4. And Table 4 is the annuity table. Okay, so this is what you're going to use when you have more than one payment with equal amounts. So for example, if you had 5 payments of $24,000, which was the example we had with we talked about earlier, you could go through and you could calculate 5 calculations using Table 3 of what the present value was for each year, year 1, year 2, year 3, year 4, year 5 separately, and then add them all together. Or you could use this table. And what you do is the same thing here. You go through and you say, okay, I think that example was we had a present value, they were using a discount rate of 10% or 12%. So this is our discount rate. And so 12% is our discount factor. And then we have 5 years. So we have 5 years over here, 5 payments. So we look where 5 years intersects with 12%. And what we end up doing is we use this number here, 3.60478. You can't see it here, I didn't look at it in the book. And then we're going to multiply that by the amount of one payment. And that's going to tell us what the present value of those 5 payments would be, knowing that some of them are in 5 years, some are in 4, some are in 1, but it's going to factor all those in and tell us what the present value of those total payments would be. So if we have an annuity, we only have to do the calculation one time. If we have individual amounts, we have to do it however many individual amounts we have. So when I'm going through the examples for net present value and internal rate of return, we're going to be referring back to these tables. Just keep that in mind. Table 3 is the single payment lump sum. Table 4 is the annuity. Okay? So that's what we have for our tables. All right, so with that in mind, the best calculations to do for capital budgeting are the ones that use time value of money, which is the present value that we just talked about. And the first method we're going to talk about on that is something called net present value, NPV. This is on page, well really it's over on page 1210. And it's by far the most commonly used form of capital budgeting tool to evaluate projects. What you do is you look at the cash flows in the future, okay, and you go through and you see what the value is in the future, then you discount those back to the current date, and then you add them all up, and if you have a positive net present value, that tells you the project is going to give you a positive return. If you have a negative net present value, then that means a project is going to actually end up losing you money and you shouldn't do it. If you have 3 projects, the one that gives you the highest net present value is going to be the one that's going to be the best choice for you. The advantage this has over the cash payback period is that not only does it use time value money, but this tells you if you basically are in a positive or negative situation, not just when you're going to get your money back. So this is the preferred method, but it is a little bit more work. So with that in mind, let's go over to page 1210, and they talk about, again, the Stewart Company over there. In this particular case, the Stewart Company, it had its cash flows, so it had annual cash flows. And they were equal. They were $24,000 a year, so that's great because that means it's an annuity. So since it's $24,000 per year, we can multiply that by our factor that's going to come from Table 4. Table 4 is our annuity. And they tell us it's 12%, so if we go over to the 12% column, and then we have for 10 periods, we go down for 10 periods or 10 years and see where they crisscross. The factor we get is 5.65022. That's our present value factor. Now all we do is we multiply that by the single payment, and that's going to give us a present value of $135,605. That's the present value of all of our cash inflows we're going to get for the next 5 years. But that's not yet our answer, because we want the net present value. This is the present value of the cash inflows. Now what we need to do is we need to subtract out the amount that we're going to pay out, which is how much we're going to pay now. That was the $130,000 that the project was going to cost. All right? And since if we buy this piece of equipment, we're going to buy it now, we don't have to discount it because it's already in today's dollars. So we would subtract the investment, the initial investment. That's going to be done today, so there's no discount. And that's $130,000. So since we would be bringing in $135,605 in today's present dollars, but sending out $130,000, $5,605 would be our net present value. Okay? So that's how you find net present value. And again, if this is a positive number, then it's a good project for us to do. If it's a negative, we wouldn't want to do it. The higher the positive, the better off. So when you send your proposal in and the committee is looking at all the proposals, they're looking at these numbers and ranking them according to the highest present value number. Okay. Now, this works great if you have an annuity, right? Because boom, we're done. That's a pretty easy one. But what happens if we don't have an annuity? What happens if we have payments that are uneven every year? Well, it's kind of like what we had to do with the cash payback. We have to do more work. And so that's the example they give us on 1211, page 1211, is they go through and they tell us, well, we've actually got, see if I can get this number done here. I think I can do this. They tell us we have 10 years. Too bad they can't give us a 5-year one, right? So let's break this one off. So we have 10 years. So this is going to be the year. And then we're going to have year 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. And then we look at what the annual cash flow is. The annual net cash flow. Again, this is if we have money coming in, we take that. If we have expenses going out, we subtract it. This is the net number for each year. So if I had $100,000 income coming in and I had $66,000 of expenses I had to pay, I'd have a net cash inflow of $34,000. And that's what we have for the first year. We have $34,000 positive. We have $30,000. We have 27, and I'm just going to stop there because you'll get the idea real quick of what we're doing. So that's our numbers. Then what we're going to do, and then we're going to have all the rest of our numbers going down. Then what we have to do is we have to do our present value discount factor. Well, since these are all individual amounts and they're all different, we can't use the annuity on table 4, so we have to use table 3. Table 3 is the amount we use for the individual payments. Again, our discount is 12%, so we go to table 3, we go over to the 12% column, and then we go down to year 1 and we look across there and we see that's 0.89286. And then for year 2, we go, what's the factor for that? Well, right below in the 12 column, under year 2, we see 0.79719. And then for year 3, you see where we're going here, 0.71178. We have to do this individually all the way down to year 10, so that's why I'm not going to do all these. But once we've done that, then we just go through and we do our math. So this is going to give us our present value, PV for present value. So 34,000 times 0.89286 is 30,357. So even though 34,000, we're going to get it in a year, it doesn't discount too much. It goes down in value some. Think of it, if the factor here, I think, is 12%. If inflation was 12%, you'd be losing purchasing power really quickly. We multiply this out. That goes down to 23,916. This goes down to 19,218. And then we would just keep doing the calculations, looking up the appropriate factor, using the appropriate year in the 12 column. And then we would just come down to these numbers. And you can see why you like to do annuities. Because you do it once, you're done. Here, you have to do it 10 times. But you don't have a choice. Sometimes you have to do it this way. And then what we would do is we would add this up. And in this case, the example is 144,367. That's the sum of all 10 of these calculations. And again, that's the present value of the cash flows. That's not our net present value yet, though, because we have to go through and find what our present value is, net present value is. So we have to subtract the investment up front. Again, that's in today's dollars, so we don't have to discount that. So that's 130,000. And so subtract that as an outflow, and then our net present value, our NPV, net present value, would be $14,367. So if you have even cash flows, or if you have odd cash flows, you can still use the tables to go through and find the present value of all the future cash that's coming in, net inflows, and then you can subtract your current investments that you have to make to buy the equipment to come up with your net present value. So all the calculations you're going to do with net present value are going to kind of tie into this. Now, they get a little confusing sometimes because you might have a case where you go through, for example, and you have a piece of equipment that you buy and it's going to have cash inflows for, say, the next 5 years, and then at the end you're going to sell it. Well, in that case, you would go through and you do the calculation. You'd still find the present value of those cash payments or those cash inflows, that cash coming in every year, So you'd use the annuity or table 4 for that calculation, but then you'd have another line where you would take that amount of the salvage value that you're going to sell at the end of 10 years. Say you're going to sell this at the end of 10 years for $10,000. That $10,000 you know is not worth $10,000 in today's dollars. You have to discount that back. So you would just do the calculation for the $10,000 using table 3 as a lump sum. And then you would add those two together to see your total present value for the project. So you're probably going to end up using both table 3 and table 4 a lot, and on some of the homework and problems, even using both of them within the same problem. So don't let that throw you. Okay? So that's the present value, net present value. And like I said, that is by far the most common form of going through and using present value. As a matter of fact, a lot of companies, present value and payback are the only two things that they use. We are going to talk about some more tools, but those are the two biggest ones. They talk about choosing a discount rate over on page 12. Basically, the rates are always going to be given to you in this class, so you don't have to worry about that. But the rates are based upon what they call cost of capital, usually how much the company could borrow. If it went, they'd have to pay as a rate if they went to the bank. That would be their cost of capital. And then if the project is risky, they might add a risk factor onto that, but you don't have to worry about that. See what else. That's kind of the big piece right there. They do talk over on page 1217 about what happens if you have two projects that are mutually exclusive. In other words, you can either do project A or project B, but you can't do both of them. Maybe project A is one piece of equipment, project B is another piece of equipment. You're trying to decide which one should I do, because obviously you don't need both of them. And so they walk you through how you can do the calculation. Again, you're still wanting to use time value of money, so you're going to use your present value calculations. Get this cleaned up here so we have room to work. And you're going to do a side-by-side comparison. So they give the example on page 1217 of two projects, Project A and Project B. And so they have, we have Project A, and then we have Project B. And so they go through and they give us the information, the initial investment, how much we're going to have to pay up front, is going to be $40,000 for Project A. So that's the money we spend to invest up front. Project B is larger, it's going to take $90,000. So they're not exactly the same. So we want to know, we don't know which one to go for. Then we look at the salvage value. The salvage value is the amount that we're going to get back at the end of the time period. So Project A, that piece of equipment is going to be worth $10,000 in the project. And Project B, that piece of equipment is going to be worth $19,000. Well, got them out of order, it's okay. Then we have our net annual cash flow. So this is how much money we're going to receive each year. It's going to be, again, the cash inflows minus the cash outflows each year. And so for Project A, that net number is going to be, I should write it the right way here. Don't copy my numbers wrong. That should be 5,000 salvage value and 10,000 for the cash flow. And this should be salvage value of 10,000 and annual cash flow of 19. Always helps if you write the numbers down correctly. So now what are we going to do? Well, the first thing we want to do is we want to go through and we do want to find the present value of the cash flows. So what are the cash flows going to be? Let's do the present value of the cash flows. So for Project A, let's do A. We have the annual cash flows. Those are going to be $10,000 a year. And we need to take them out. What's the time period for this? If you read, they tell you it's 10 years and we're going to use a 12% discount rate. Okay? So that would be 10 years. We're going to go, because it's an annuity, because it's the same $10,000 every year, we're going to go to table 4. And we're going to go across to 12%, because that's where they told us the 12% was. It's the discount rate. And we're going to go down to 10 on the left on the payments, because that's how many years, or how many payments we're going to have. And we're going to see 5.65022. So that means, multiplied by 10,000, that the value of that is going to be, oh, should do my math here, $56,502. We're going to do the same thing for Project B. Okay, project B, the annual cash flow is going to be 19,000 times the same number, because it's the same time period, 5.65022. And of course I don't have that number in front of me, so I get my calculator. In the book they lumped them together, but I want to show you how you'd set this up so you could be able to know how to calculate this if this were to be a problem. So the 19,000 times 5.65022 is going to give us a present value of those payments of $107,354. So that's our annual cash flows, but that's not the only cash we're going to receive in the future. We're also, at the end of these time periods, going to sell these pieces of equipment and we're going to get some money back. So for A, let's look at the salvage value, the present value of the salvage. We're going to get $5,000. Both of those were table 4. We're going to get salvage value of $5,000. And we're going to multiply that by some discount factor, but we're only going to get one payment. So since we're only going to get one payment, we're going to use table 3. And so if we go over to table 3, again, we're going to go over to 12%, because that's what our discount is on all these. That's the percentage. We're going to go down to 10, because it's the 10th year is when this payment occurs. Go across, and if you do that, you should see a factor. That looks like 0.32197. And if we do that, we should end up with 0.32197, 1,006, and round up to 10, 1,010. Okay. So if I add those two together, 56502 plus 1610, I get 5812. Good. Making sure it equals 5812. Okay. That's the present value of my cash flows. And then I do the same thing for project B. In project B, I need to go through and I need to take 10,000. I'm not doing a very good job of keeping my whiteboard management skills. I'll never learn that. I'll just never learn to be a good management whiteboard. So B, that's going to be my present value of my salvage. That's going to be 19,000 times the same number, because it was same 12% in 10 years. So it's going to be the same discount factor, 0.32197 from table 3. And that's going to calculate out to be 19 times 0.32197, 6,117. So now let's try this. That worked out to be the 5812. That did work, 5812. And then this hopefully will work, 107,354 plus 6117. All right, 113,471. Okay, didn't work. So let me see what else I'm missing here. 19,123 times 5.65022 7. Oh, 10. 10,000. Let's try that. Three, 2, 1, 9. Okay. 107,354 plus 3219. There we go. Okay. 573. In the book it's 4 because of rounding, but that works. All right. So now we've gone through and we've calculated up our present value. So that was a rather sloppy attempt to walk you through how to do a present value with both annuities and lump sums. So they just gave it to you, but I wanted to show you how to do that. So now we come over here and we look at our project A and project B, okay? So we have A and we have B. So what are we doing here? Well, we're going to take the present values of the cash flows that we just found. So let's go over here where it's less messy. And so we have 58, 112, and 110, 574. And then we're going to subtract our initial investment, so what we're going to pay up front. So we're going to spend 40 for this one, and we're going to spend 90 for this one. And the net of both of those is going to give us our net present value. So 18,112, and then 20,574. All right? So you're saying, okay, well, what do we do with that? Well, that's where we can do what's called the Profitability Index, okay? Because the Profitability Index is going to help us look at the amount of profit we're going to receive compared to the investment we have to make. So we're looking for a number that's going to give us a higher return, okay? So that formula is going to be the net present values of the cash flows divided by the investment. Okay? So over here, we're going to take the net present value of the cash flows. So it's going to be, actually it's the present value of the cash flows. I always get confused, but it's actually this number. We're going to use this number and this number. So it's 58,112 divided by the by the 40. That's our initial investment, and that's going to give us 1.45. That's our profitability index. Over here, see if I can get this right, that's going to be the 110,574, which is the amount of the, again, present value of the cash flows. We're going to divide that by the 90,000, okay? And that's going to give us 1.23. Now, the higher number means that we're getting a better return in terms of how much profit is being generated for our investment. And so in this case, the reason I did the net present value is you can see if you just use net present value, you'd say, well, wait a minute, this has got the higher net present value, option B, so we should do that. And that's true, it does give us the high net present value. But here's the other thing you've got to keep in mind. It also requires us to invest $90,000, whereas Project A only requires us to invest $40,000. So now what happens is if we look at it, it turns out that Project A, while it's not as high a net present value, gives us a higher profitability because it gets more profit out of the investment. So again, this is another way to look at it. If we were trying to invest between these two and look at them, we would want to go with Project A. Okay. So that's mutually exclusive projects and looking at the profitability index. Another methodology that we use, sometimes companies use fairly often, is called the internal rate of return method. And it's a time value of money. What it does is it says, let's look at what the cash flows that we're going to generate are over the investment and use that to generate an internal rate of return. And then most companies will pick a hurdle rate. They're going to say, we don't want to invest in a project unless it gives us an internal rate of return, or IRR, of at least 12%. So when people do the calculation for their projects, if it comes in at 12% or higher, then it looks like it would meet that criteria. It should be a good project to consider. If it's below 12%, don't even bother talking about it because it doesn't give us enough return to make it worthwhile. The higher the IRR, the more attractive it is. So if you have a lot of projects and you can't do them all, you look at the IRR and you choose the ones that have the highest IRR. So companies will use the internal rate of return. It's kind of the same thing as a net present value, just net present value, you're finding the actual dollar amount of the present value of the cash flows. Internal rate of return, you're converting it into a percentage, so then you can rank the percentages or see if they meet a hurdle rate. So that's over on page 1220, they start talking about that. And you can see the way it works is that the internal rate of return is where the present value of all of the outflows is exactly equal to the present value of all of the inflows. In other words, your return is 0. But to go through and to do this calculation for 10% and 11% and 12% until you find one that works to make everything 0, where this number, net present value, comes out to be 0, you don't want to do that. So instead we're going to use a little shortcut. So in this case, what we're going to do is, the calculation is pretty straightforward. When you get in your upper division finance, they'll probably just have you get a calculator. You push the buttons in, put the numbers in, push a button, it's going to tell you what the IRR is. But since we're using the tables, we're going to kind of work backwards into how to use the tables. So the way that you're going to find your internal rate of return is you're going to look for something called the internal, let's see, how do I want to do this? I think I'll do this because I'm going to turn this on. Internal rate of return factor. That factor is the number that's in the tables. Okay, so we're basically engineering back to find the amount that's on the tables. So what happens is this: they go through and they tell us, well, in this example, Stewart Shipping on page 1220, they had a capital investment. So I'm going to take the capital investment, and we want to divide that capital investment by the net annual cash flows. All right? That's going to give us our internal rate of return factor. This isn't the IRR, the internal rate of return. This is the factor that we're then going to use to go over and look onto the tables. So in this particular case, they say, well, the investment, the capital investment was $244,371. That's how much we're going to have to spend for this particular project. Okay? The amount, the annual cash inflows that we're going to get is going to be $100,000 a year. That's how much we're going to get coming back. So if we do that number, we end up with 2.44371. That's not a percentage. That's one of those factors that's over on the tables. And in this particular case, because we're talking about an annuity, because this $100,000 is per year for 3 years, that makes it an annuity because it's an equal payment, $100,000 for each year for more than 1 year. So we're going to go over to table 4 and we're going to look in the 3, because there's 3 payments, row, and we're going to go across and see which number is closest to this number, and then we're going to go up and see what that percentage is. Okay? And then that's going to help us figure out how to find the amount for the rate. And so just to show you that, again, you're going to be using these tables a lot, so when it comes time for the test, what will happen is I'll just make copies of the tables and have an attachment for table 3 and table 4. So obviously you won't have to memorize the tables, but you're still going to have to know how to use them. So you should get used to looking at them. The book sometimes gives you the factor. You should know how to go to the table and pull the factor off. So here we are. We're at table 4. It's an annuity because we said this is an annuity. And we're on the line 3 because we have 3 payments. And all we do, we're looking for this number 2.44371. So we go across and we just see what's our closest number. What's our closest number? Well, it turns out this happens to be exactly the number, conveniently. And we go up to the top, we would see that's 11%. So that tells us our internal rate of return for this project is 11%. Sometimes it's not exactly that number. It could be between 2 numbers. So you'd know it's between 10 or 11%. Now, you don't have to worry about if it's 10.5 or 10.25. If you know it's between 10 or 11, but the book says if their hurdle rate is 9%, so that means anything that's above 9% you should accept because it's above their hurdle rate. Well, if you know that it's at least 10%, you know that project should be accepted. So if you ever run into a question where it's asking you to find the rate and it doesn't give you the exact amount to one of these tables, look and see if the question isn't saying there's a hurdle rate and see if the number that you know is somewhere between those two will be higher than the hurdle rate. If it is, you should still accept the project. If not, then you wouldn't do that. So that's using the internal rate of return method. So again, you kind of work backwards to go to the tables as opposed to the present value, net present value, where you go to the tables to use it to find your number. So kind of coming at it from two different directions, but it's doing the same thing. The last section we have on page 1222 is the annual rate of return. And the annual rate of return is very similar to the cash payback period. It's simple. We don't have any tables. There's no present value here, so it's not as accurate, but it's easier to understand. But there is one thing that's a little confusing, okay? Because people get this confused all the time, the annual rate of return with the cash payback period, because they're very similar. So let me write both of these down so we can make sure we're straight. So the annual rate of return formula is this. Annual rate of return is going to equal the expected annual net income. So this is going to come off your income statement divided by your average investment. Now there's a couple things I want to highlight, the difference between this and the cash payback period. Because the cash payback period formula, if you remember that, the cash payback period formula was the amount of the initial investment, so the cost of the investment divided by the annual cash, net cash flows. Annual net cash flows. So the first thing is the formulas look very, very similar. They're not. They're different, but they get confused. Okay? So here's the big difference. Over here, when we were using the cash payback period, all right, we were using the full cost of the investment. Over here, we're using the average investment. So the number here is going to be what we paid for the project up front plus what we get at the end divided by 2. That's a big difference. People always forget that. So annual rate of return is average. Cash payback, or payback period is just the same amount. The other big one is the payback period uses annual net cash flows. This is only looking at cash, okay? Over here, on annual rate of return, we're using net income. Now, why is that different? It has to do primarily in this book and examples with depreciation. Because if you remember, over here in the cash flows, we do not use depreciation. Do not include depreciation expense in the cash flows. Because depreciation is not an expense. There's no cash going out. We write it off, but there is no cash. So depreciation is not included in the cash flows. If you have a list of expenses to find your cash flows and depreciation is listed as one of those expenses, you do not include it in the cash payback period because it's cash flows. Over here, you do include it because this is net income. And net income is GAAP-based and it has the depreciation expense in it. So here, you do include depreciation expense in the net income that you're using. So because they're similar, students get them confused and they don't realize that. I want to make that point very, very clear. So if you're doing annual rate of return, you use your net income. If you're given a list of expenses and some revenues, you're going to just do an income statement with revenues minus all the expenses, including subtracting depreciation expense to get to net income for this calculation. If that same problem you have, you're asked to find the cash flows and depreciation is given, you do not include depreciation in the cash flows with the cash payback. So I just want to make that point clear. Having said that, then this calculation is actually pretty easy because they pretty much give you all the information. And so the only tricky thing you need to remember if you're trying to find the average investment, like I said over here, that's going to be your original investment plus the salvage value, if you have any. If it's not, it's 0. Divided by 2, because that's what your average is, your average investment. So the number they give you here, they give you on page 1222, they give you a little income statement. They say the company had $200,000 in sales. They had some expenses, including depreciation expense, and they ended up with net income of $13,000. And so the initial investment they had was a $130,000 piece of equipment that has no salvage value at the end. So you're going to pay $130,000 for a piece of equipment up front. That's the original investment. The salvage value is 0, so we want to find an average. That average is going to be $65,000. The amount of the income that you're going to receive, they give you, and the income statement was $13,000. So you just do the calculation like we did here to find your annual rate of return, and that works out to be 20%. And so what you would do is this calculation on your different projects, and then you would rank the projects. The higher the return, the better off the project, the more desirable it is. But again, this doesn't do anything with time value money, so just like the cash payback period, both of these, if you go more than 5 years, your probably time value money is big enough of a factor it could have a big impact on your decision. So these are great for little projects that aren't big dollar amounts, or maybe to go out to up to 5 years. But to anything above that, you really should be using the net present value method or the internal rate of return method. So again, all of these are really, they're finance. This isn't accounting, of course. This is finance, and we're using this to go through and evaluate and rank different choices. So as a manager, one of your jobs is to make decisions about, when you have different choices, which are the best choices. These are financial tools that you can utilize to evaluate investments in longer term projects. So I think that's pretty much it in chapter 26. Don't remember anything else jumping out. A lot of little calculations, so you just need to go through. It's not a bad idea to get flashcards. There's some formulas in here to keep straight, so maybe get some flashcards and run through them. And then just practice. You have a lot of problems in the homework to go through and practice the different present value calculations, just to make sure you're comfortable with using table 3 for the lump sum and then table 4 for the annuities. So hopefully that was helpful.